Do you have a 401k, IRA? So, you're an investor. And very likely the two asset types most represented in your portfolio of investments are stocks and bonds, frequently referred to as equity and debt. So, what exactly is it that you own? Not sure? Stay tuned. Investing Basics, Understanding Stocks and Bonds, coming up. Jeff Drayton, Certified Financial Planner Professional and founder of Jeffrey A. Drayton Financial Planning and Wealth Management, LLC. If you're watching this on YouTube, don't forget to subscribe. And if you are watching this on the blog page of my website, fill out the contact form at the top of the page so that we can contact you when new content becomes available. Whether your portfolio is made up of mutual funds, exchange-traded funds, or even specific individual holdings, there are likely two asset types that are well represented. These are stocks and bonds, what we refer to as equity and debt. For many investors, these two asset classes plus cash or its equivalents might very well make up their entire portfolio. So, when you purchase a stock or a bond or a fund that contains them, what exactly do you own? Here, I'm going to explain what stocks and bonds are and give you some understanding of the potential benefits and risks of each. Here goes. First up, let me just explain what each asset is, what it is that you own for having purchased it. Starting with bonds. When you buy a bond from someone, possibly a company, or the government, which could either be foreign or domestic and from any level, federal, state, or even a city or municipality, what you have done is lent money. You have given them your money and they will agree to pay you interest and eventually return your principal. You are a lender and they have borrowed money from you. Hence, bonds are often referred to as debt. Stock, on the other hand, is issued by companies. When you purchase stock, you are becoming a part owner of that company. Since another term for ownership is equity, frequently this is the term used to refer to stock. As you can see, stocks and bonds are quite different. You have a very different relationship with the issuer when you purchase a bond versus having purchased stock. Bonds make you a creditor. Stock means you're an owner. However, from an investor's perspective, there are similarities between stocks and bonds. Two worth noting are, both stocks and bonds have basically two values. The first is present value. This is their market value, the value that you could get for that stock or bond were you to decide to liquidate it for cash. This is done by simply selling it on what we refer to as the secondary market. For widely traded stocks and bonds, it is accomplished by simply placing a sell order with your brokerage firm. The second value is the opportunity to receive an income stream from your stock or your bond. In the case of a bond, the income stream would be in the form of the interest payments that are being paid to you by the issuer as their cost for having borrowed your money. For stocks, the potential income stream comes in the form of dividend payments. Since, as a stockholder, you are a part owner of the company, if the company makes a profit, you might receive a payment from the company for your proportional share of those profits. These payments are made in the form of dividends on your stock. So, stocks and bonds have both a present or market value and the potential to produce income. However, this is about where their similarities end. Again, owning stock versus purchasing a bond puts you in a very different relationship with the issuer. Therefore, the way these two values are calculated is also quite different. For stocks, market value is fairly straightforward. Stocks trade on exchanges, and therefore, the market value is whatever the current market price per share is for your stock, multiplied by the number of shares that you own. Of course, determining how that market price is set is a bit more complicated. On a fundamental level, the market value of a stock is simply determined by supply and demand. For any publicly traded company, the companies in which you can buy stock, there are a fixed number of shares available. For large companies, it's a big number. However, in order for you to purchase shares of stock in a company, someone else who already owns those shares will need to be willing to sell. The function of a stock exchange is to match buyers to sellers and make sure there is an equal number of each. The way they do this is to adjust the trading price of the stock. Imagine I want to buy shares in Microsoft. If the day my order goes to the stock market, there are more people wanting to buy Microsoft stock than who want to sell, the price will go up. This will discourage buyers and encourage sellers. The price will go up however much is necessary until an equilibrium between buyers and sellers is reached. If the reverse is true, more sellers than buyers, then the opposite will happen. The price will go down. Analysts speculate all the time as to the many factors that they believe will influence the price of a stock. However, at the end of the day, all that speculation is really just to determine how many buyers and sellers and in what proportion they anticipate will show up for a stock on any given day. Again, stock prices are market driven. It's just a matter of supply and demand. Calculating the market value of a bond, on the other hand, is quite a bit different. However, before I talk about that, let me take a minute to explain a little about some of what is typically true of bonds. Commonly, bonds are bought and sold in $1,000 increments. This is the face value of the bond. When you lend money by purchasing a bond, you will likely be lending that money $1,000 at a time with each bond that you buy. At the time the bond is issued, the issuer of that bond will set the interest rate that they are going to pay. Of course, in order to attract buyers for their bonds or to borrow the money that they are seeking, the interest rate that they set for their bonds will have to be competitive. They will have to pay the market interest rate for entities that have similar credit ratings to their own. A little side note. With bonds, this interest rate is frequently referred to as the bond's coupon rate, and the interest payments that bonds make are called coupon payments. This comes from the fact that at one time when you purchased a bond, you received a bond certificate, and that certificate had coupons attached that you would tear off and present to the issuer to receive your interest payments, hence coupon payments. Although that is all now quite archaic, the term is still used, and many people still refer to bond interest payments as coupon payments. Bonds frequently make their coupon payments semi-annually. Therefore, if you purchase an individual bond, you will likely receive your interest as 2 payments per year. So, what does all of this have to do with a bond's market value? Well, it turns out everything. I think generally there's a far better understanding regarding how the market value of stock is determined than for bonds, and it's easy to understand why. The calculation for a bond's market value is a bit complicated, but let's give it a shot. Imagine I buy a bond at issue, and it is a 10-year bond that is paying 5% interest. This means that I'm going to give the bond issuer my $1,000, and they are going to pay me interest in the amount of 5% of $1,000, or $50 a year for the next 10 years. Again, bonds typically pay their interest semi-annually, so I will likely get 2 payments per year of $25 each. At the end of 10 years, the bond will mature, and I will get a return of principal, which is to say, I will get my $1,000 back. But now let's say that after 4 years, I need some money, and therefore I decide to sell my bond. Bond market values have an inverse relationship to interest rates, meaning if interest rates have gone up, the value of my bond will have gone down, and vice versa. This might seem counterintuitive at first. Since bonds pay interest, wouldn't it be a good thing if interest rates go up? Well, remember, the interest rate that my bond is paying was set when the bond was issued. Therefore, it actually makes perfect sense why my bond will now be less valuable if current market interest rates have gone up. If my bond is paying 5%, but similar bonds are now paying, say, 7%, who would want to pay me the $1,000 face value for my bond when they could simply go buy a new bond and earn 7% instead of the 5% that mine is paying? That has a simple answer. They won't. But that doesn't mean that I won't be able to sell my bond. My bond is marketable. Someone will be willing to buy it. They just won't be willing to pay the $1,000 face value for it. The rise in current interest rates has decreased the market value of my bond. So, what is my bond worth? To determine that, we would input into a bond calculator the facts that my bond is going to make 12 more semi-annual payments of $25 each. The owner will then receive a return of principal of $1,000, and that the current interest rates for comparable bonds is now 7%. Given that set of facts, my bond has a current market value of just slightly more than $900. Selling my bond now will mean that I will lose approximately $100 of principal. However, had interest rates gone in the opposite direction, which is to say, were they now less than the 5% that my bond is paying, now my bond would be worth more than its $1,000 face value. Again, this makes perfect sense. If my bond is paying 5%, but similar bonds being issued in the market today are only paying, say, 3%, that makes my bond worth more. I would get a premium over the face value should I choose to sell my bond. So, now that you know what stocks and bonds are and the ways that they can provide you with an investment return, which is the right investment for you? Well, like most things financial planning, the answer is It depends. If your objective is a high rate of growth, the opportunity for your investment to achieve a significant appreciation in value, that would tend to favor stocks. As we have already learned, both the value of stocks and bonds can fluctuate. However, with bonds, the opportunity for an appreciation in its market value is going to be fairly confined. Although interest rates change all the time and your bond's market value will go up and down, that fluctuation is not unlimited. A stock, on the other hand, is only limited by the companies in whose stock you have purchased ability to grow. And for some companies, that growth has been very impressive. However, with the ability for impressive growth, which is to say the potential for large movement in the stock's market value, comes volatility. And volatility in investing is simply another way of saying risk. If, as opposed to growth, what you are most interested in is a consistent income stream or a consistent payment from your investment, that would tend to favor bonds. Remember, stocks can provide an income stream in the form of dividend payments, and some companies are quite consistent dividend payers. However, dividends are not guaranteed. Even if a company has profits, it is not required to pay those profits out to the stockholders in the form of dividends. Frequently, companies have very good reasons not to. Maybe they are in growth mode, focusing on increasing the value of the company to their stockholders, and in that case, they might instead choose to reinvest those profits back into the company, presumably to drive that growth. The interest or coupon payment on a bond is not optional, any more than the interest payments that you make to your bank for your mortgage or on your car loan are optional. If a company issues a bond that you purchase, they will need to make those interest payments to you whether they have a profit, don't have a profit, in short, whether they want to or not. The only reason you would not receive your interest payment on a bond would be were the issuer to be unable to fulfill their obligation to make those payments, in which case your bond would be in default. Unfortunately, default risk is a risk in purchasing some bonds, and therefore you will want to know the rating of a bond prior to making your purchase. There are a number of companies that provide such ratings for bonds, which basically amounts to an evaluation of the credit worthiness of the bond's issuer. So, there you have it. Stocks and bonds, equity and debt. If you'd like to learn more about the investments that you are making, those assets that you are adding to your investment portfolio, I would highly recommend that you seek the advice of a hopefully certified financial planner professional. I'm Jeff Drayton. Thanks for watching. Hey everyone, as always, nothing in this video is meant to be specific advice for you. Advice like that can only be had by working with a financial planner, someone who knows you and your situation. I would encourage you to seek out someone who is a certified financial planner. This is signified by the letters CFP with the registered trademark sign following his or her name. I would also encourage you to work with a fee-only financial planner. That's two words, fee-only, not fee-based, not fee plus commission. Both of those terms mean that the planner or advisor can receive commissions and is therefore not free of the conflict of interest inherent to commission sales. Again, I'm Jeff Drayton. Thanks for watching.